right, welcome to Sound Financial Bites, our YouTube channel, the podcast. If you guys haven't yet had a chance to meet Cory Shepherd, allow me to reintroduce you to him, author of the wonderful book called Cape Not Required, writer on Discover Your Power, public speaker, consummate student, Cory Shepherd. Glad you could be here.
Big green egg aficionado and modernist chef. You should add those in.
I don't even know what a green egg aficionado is.
Big green egg, giant smoker.
Oh, a green egg aficionado. My
nephew just calls it hot. He's 1 year old. Hot.
Yeah, that thing is smoking. Yeah. The guy's an amazing cook. I'm Paul Adams, and it's so good to have you here. Okay, today we're talking about universal life insurance. Universal life insurance is not what you would think. It's like a Frankenstein. I don't mean that to sound negative, but boy, that's a hard one to make sound positive. But think of it this way.
It sounds pretty negative. We don't mean it that way.
We don't mean it to be negative. The product itself has enough potential problems in the way it's implemented that you don't have to be very mean about the product itself. Here's how to think about it. Term insurance is on one end. At some way, ever increasing cost of insurance, just very clear, because if it's level for a period of time, then it goes up. It's very clear that it's gone up. Whole life insurance on the other end is a guaranteed level premium forever and guaranteed to pay death benefit. Universal life sits in between the two, but lives more on the term insurance chassis. So what happened years ago is people said, well, what I'm going to do is buy term insurance and invest what's left over and not acquire any whole life insurance. So I'm going to buy term, invest the difference. And the industry said, well, how about we give you a product where you can do that right here with us? Now, remember in our earlier episode, I shared about how companies were not that good at marketing pre-1970. They got really good after this because they named it Universal Life Insurance.
This is like for all of our non-car folks listening, chassis, meaning a car company has an existing car and then they release this brand new car. We find out later is really the old car on its base, but just like a new outside put on top of it, basically. That is term insurance and then universal life. Yes. And that was new marketing that was added, right?
And consider that universal life, you could think of it simply as overfunded term insurance, okay? And the hope is you overfund it enough that one day the money inside of it will pay that ever increasing cost of mortality, that insurance cost every single year. Now, let me give you a quick drawing of what it might look like. All right, so universal life, the way that it works is we put money in and there is a cost inside the universal life, which I'm going to show as red. So we have a level death benefit, and that's a death benefit that can be set to increase or stay level. For the sake of this conversation, we're going to keep it level, a little easier to understand.
Easier for us to explain.
Yes. And it has a really low cost of insurance inside of it, much like term insurance would, especially in the early years. It's an annual renewable amount, keeps up with your age.
But it is higher than term insurance for the equal amount of death benefit.
Yes. Yes. It's higher premium. And let's say it's just going to be overfunded term. It might be 5X, 10X, 15X. You can choose how much you put in. The hope of the purveyors of this type of contract is that what will happen is we will build up enough cash value so that in later years, there's very little amount at risk for the insurance company between the death benefit and that cash value. And therefore, it won't be that much of a burden for the cash value to pay that cost of death benefit. But the real issue comes out when anytime we take money out of a universal life policy, we run the risk of widening that gap again. And as we widen that gap, it gets worse and worse. And eventually, the wider the gap, the more withdrawals, the more likely we're going to crater the cash value. And as soon as the cash value is gone in a regular universal life insurance policy, or what's called a current assumptions universal life policy, it goes away entirely. So think of it this way. You as the insured get this incredible flexibility. You don't have to pay the same premium every year. You could pay $12,000 for that policy one year, only put in $3,000 the next year, put in $30,000 maybe the following year. You have all kinds of flexibility, and that's how it's sold. But necessarily, the more flexibility you have as the insured, the more flexibility the insurance company has. And they can change what rate of return. If it's a current assumptions contract, meaning that the insurance company sets the actual interest rate every year, they can change that interest rate. And if things are going hard for them, they can lower it. And they lower what they pay you in interest rate. If costs get too bad for them, they can raise the mortality costs in those contracts. Or if another major insurance company buys somebody with a large book of universal life insurance business, they could intentionally do that as a profit-making strategy. As long as they do it to everybody, that's part of the law. They just have to do it to everybody.
And that's not a gross hypothetical. We've seen evidence that may have happened.
Yeah. And more common that universal life ends up going to guarantees than we've seen whole life go to guarantees in the past. And it has to do with these underlying mechanics that most universal life insurance sold is sold from stock insurance companies. So we're going to talk more in a few minutes about stockholders pitted against, if you will, policyholders and how there's different interests at play on both sides. But the big deal is when this happens and that X occurs and the life insurance is gone, what happens to the insured? They have no more coverage. And if part of that drawdown actually entailed that person taking money out and putting it on their own balance sheet somehow or spending it, they may actually hit something called the surrender squeeze, where they're withdrawing money, perhaps for retirement income, and the policy values are going down, 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 which means every single year the gap is getting wider, that the mortality costs have to be paid. And then last but not least, the insured actually ends up with no policy and may have to pay gains like regular taxable income all in one year for all the past withdrawals. So think about this. It's almost like a Sophie's Choice.
It sounds like something you catch in Mexico when you drink the water, a surrender squeeze. And the more you explain it, the more it sounds like that.
So if you're there, you may be in a position where they say, hey, your amount of premiums you've been paying aren't cutting it anymore. You need to pay 3 times the amount of premium. And if you don't, meaning you don't keep that policy in force, the IRS may be sending you a huge tax bill.
For money that you no longer have.
For money you've already spent.
Yeah.
And this may not happen until your 70s or 80s. Okay. I'm going to talk about how to know if you have a policy like this and if it does that so we can equip you guys properly. That's a big deal.
But really big deal that from this graph, I love that you drew that, Paul, because someone could say, well, if I'm not going to take money out. Like maybe I'm not, but the problem is the insurance company is. Yes. Whether you do or not, especially at older ages, because your cost of insurance is going up every year as you get older. So we've seen where that graph can happen. If you put in loads of money, like if term is nothing, is very low, whole life is 10x, and universal life is anywhere in between, let's be real. People tend to get marketed a universal life policy when they want to put in much less than whole life.
Much less, yes.
Which leaves them more open to the withdrawals from age costs causing that graph, whether or not they do anything.
Yeah, the vagaries of the market, if you will. And I've said in both of my books, if you are playing a game with an 800-pound gorilla, okay, what we want to do is make sure the gorilla is tied up as securely as possible. And in this case, the insurance company, it sounds good to us, like, oh, look at all this flexibility you have. Unfortunately, they have it too. And they have, it's a much bigger consequence to us as an individual if the rules change partway through and say we're not insurable anymore. Okay, we have to be insurable to acquire life insurance. We could have one of these contracts and one day it doesn't take care of us anymore. And these can be funded properly, by the way. They can be managed properly, they can be funded properly, and they can work well. But it's not natural for people to do that. Okay. Now, what also happens is there's different flavors of it. We're going to touch on the other ones. There's current UL, meaning the insurance company just promises an interest rate every year. There's also variable universal life, which means you can invest in things that look a lot like mutual funds, but they're called separate accounts. And they may even mirror nearly an actual retail mutual fund, but it's called a separate account inside the life insurance policy. So you can build a little portfolio of these separate accounts inside the investment and participate in market growth. And we'll talk about that in a few minutes. And then the last one is called indexed universal life. And we're going to talk about it specifically and what can go wrong when somebody's using indexed universal life on their own policies for their own sake. Okay. The big problem is that you end up with that surrender squeeze. You have this time in the future where you're going to have these mortality costs, and the mortality costs will go up while you are drawing down your funds, or even if you're not drawing them down, you're just putting in the same premium. But if interest rates and your mortality and the mortality charges don't cooperate, that policy will fail. And you can see it in the illustrations. I have yet to have a client request what's called an in-force illustration. We're going to talk to you about how to request one here in a few minutes. Request an illustration. So they're already 10 years in the policy. Request one. I've yet to see one that performs out to age 100 with its guarantees intact. Not one current assumptions, not one variable universal life, and not one indexed universal life. Only something called secondary guaranteed universal life, which will be our last in this series of universal life contracts.
Because can we hit quick on some of the ways that the guarantees the company makes you can be invalidated by the consumer's behavior?
On the guaranteed UL?
Yeah.
We are going to get to that.
Oh, you're doing that?
Yep.
All right,
okay.
Great. I'm just overproducing here. Don't worry about it.
So the side fund itself, if you go to a variable policy, is invested in all these mutual funds. The difference is, notice how smooth relatively the universal life curve is? That changes a lot with variable universal life. We have our funding that we're putting in, which we could put in the same amount every single year and hope the contract pans out. But the actual cash value of the contract is going to perform with volatility because it's in some kind of portfolio. Now, when the market is going up and before you retire, that could work out really, really well. The problem is anytime as you age that the market decreases in value, we are increasing the cost of mortality in those years. Because now we're in our 70s, the market pulled back 20%. Oh my word, what's going to happen to my money? Well, my cost of insurance went up, plus maybe you're taking withdrawals from that contract as a retirement income because that's how you're initially taught to use it. And no kidding, you can end up accelerating the erosion of your capital between mortality, administrative charges, and the mere and simple fact that you are taking some money out to spend it, never to go back into the contract, which then can later on collapse the contract or accelerate its collapse because, that all should have been green. Accelerate the crash.
Well, I don't know.
Of the cash value.
Looks like it's going red.
Yes.
Yeah.
And when that death benefit goes away, taxes are due on all of the money that we took out prior in excess of what we originally put in. That could be a big hit tax-wise in our later years.
So just like universal life, variable universal life is often turned to in a situation where an advisor is trying to solve for a lower amount of premium to create the same kind of life insurance, which means in those situations are more when someone is susceptible to this happening.
Yes. And if you acquired one of these, say in the 90s, you may have had that illustrated to you as a 12% annual rate of return. It was just normal. It was normal. And we would say things like the industry would say things like, we think it's going to do better than 12, but this is the most we can illustrate. So we'll just illustrate 12. But it's unique because it's also subject to something called sequence of return, which we're going to teach about in a completely separate video series because it affects all areas of your financial life. But simply put, I have seen scenarios where somebody gets over a 12% rate of return for like 40 years.
On average.
And then, like a linear 12% every year, and then a negative 10% for like 10 years. And it averages to be like 7.5%. And that performs nothing like the linear 7.5% that was illustrated on the illustration itself. And you'll notice that most purveyors, most sellers, and I mean the insurance companies, do not have an illustration system that will allow you to test real variability of your contract and what would have actually happened had you had their actual investments over that horizon of time to test whether or not it would survive both you funding it, then stopping funding at age 65, and then taking some money out. Like, it is amazing how you cannot find that. And so we're going to tell you about how to perhaps request an in-force illustration that's going to help you dust what I would call like dusting the edges off the plate in baseball so we can see where the lines are. Okay, let's get to the last one. Equity indexed universal life. And the equity indexed universal life just means this. They will have a contract with you. It sounds, I got to tell you, it sounds so good. It is what I would say a insurance agent's easiest product for them to sell, but one of the hardest products for the client to own. Okay? Easiest to be sold, hardest to be owned. Here's why.
Illustrations of life insurance are a beauty contest, this is like the front runner.
Oh, yeah. It's
acing the talent show with the batons on fire.
Yeah.
Like, oh, yeah.
And here's what they'll say. In the contract, it will read that what you can do is you can pick an index, and we're going to say the S&P 500, that you can pick the Standard & Poor's 500 index. That is a wide index of U.S. companies, largely large cap growth companies that you'll see about on the news all the time. So it sounds familiar. And they say, we will let you get up to 100% of the upside of the S&P 500, but in down years, we're going to guarantee you never get less than 1%. So you may not get higher than 10. Sometimes the cap is 12, but always nothing less than 1%. And that sounds wonderful. Like, you mean I get to get stock market rates of return, except I don't have to take the risk of really being in the market. You're going to give me a 1% guarantee. That's exactly right. Mm-hmm. That can even work well when it's in other types of financial contracts. Here's the drawback when it's in life insurance. If what you did was you got just the 1% a year, that sounds like incredible guarantees.
Too good to be true. What it sounds like.
It is true, but it may be incomplete. And the incompleteness is that the mortality charges are still there. So if all you got was a guarantee every year because the market didn't do well, you would actually lose money over time because the mortality and expense charges of the contract itself would erode your wealth inside, even at guarantees. So your guaranteed 1% increase over a 10 or 15 year period might look more like a 30% guaranteed decrease.
So it's not too good to be true. It's too good to be free.
Yes.
Yeah.
Okay. So let's chart this one out. So instead of those huge downsides, what happens is you get the rate of return of the market each year. There's the death benefit. And you get the rate of return of the market each year, but it can only go up and not go down. So you might have years it's kind of level, years it doesn't go up as much. And it's going to look more like this. It might go down a little bit if there's a few guarantee years with with mortality cost withdrawals. And it's supposed to look something like this. Here is the problem. When you put money into this contract, they have given you some guarantees. One guarantee they've said is at any given time, you get to participate 100% in your index in its point-to-point movement, which means you do not benefit from any actual dividends paid by those stocks because you don't own them. You literally own the insurance companies buying options. They're doing things to hedge this bet, but you own only the insurance company's promise that they're going to give you this point-to-point movement on that index. Now, if you only own the point-to-point movement and you don't own any of the dividends, well, in that like 70-year history that they quote of the S&P 500 doing like 11%, what they don't talk about is almost 2% of that was dividends that entire time. As a matter of fact, if we end up with favorable tax treatment of dividends, many companies that are in the S&P 500 might actually shift to pay more dividends. And if they do, you won't see that inside your contract because it doesn't affect the point-to-point movement. So that's problem one. Problem two is, so it's 100% movement of the index, but you get no dividends. No dividends. What's also problematic is you get 100%, but they can, I'm just going to put this in red because it's a big deal, move the cap. It's a great question to ask your agent if somebody's proposing this to you, is why is it that they're currently saying they're going to cap it out at 12%, but in the contract it says they could lower that at their discretion all the way down to 3%. Why is that? And you can read it right in the contract. It won't be pointed out only because it's not super flattering that it would be pointed out that they could lower it as low as 3%. And if they lower it down to 3%, you've got a real problem. Last but not least, and I don't want to get super nerdy with you here today, but I'm always happy to in a one-on-one conversation, a great deal of gains in any index or in any market are actually occurred in our really big years. Meaning that cutting off the downside seems good to us from a safety perspective, but losing all the bigger upside than the 10% might actually cost us dearly. And so when you're looking at these contracts, if they're being illustrated, well, it'll get 8% because of that rate of return. You're going to watch in one of our future videos, we're going to show you that adding money every year to the S&P 500 in a period of time when the S&P 500 returned 8.6%, if all your money was there in the beginning, your return would not have been higher than 6 because you added money over time. Again, it has to do with the timing of you adding money, not to do with the actual movement of the index. All of those things are counting against us in this contract because now we have the ability for them to drop the ceiling. We do get this guarantee. They're giving us participation, but the entire time the mortality expense charges are coming out, and probably the most damaging potential part is that you do not have to pay as much premiums as it would take to make the policy work. And we've watched modeling of these contracts work out really, really well, like all the way for 30 years. And then a string of five bad years in that time when the higher mortality expense charges are there, suddenly start to drag that contract down significantly and change its trajectory forever, requiring more premium payment from the insured or the risk of lapsing the contract. Okay, that's all the equity indexed universal life. Now, we're going to hit guaranteed universal life, then I'm going to give you guys some homework you could do if you own one of these contracts. Here's guaranteed universal life. Very simple. They make a promise with you. You pay your premiums and don't make any changes, okay? So we're going to talk about what those changes are. Cory's going to jump in there. And your cash value is you're going to have a consistent premium that has to be paid every year. You don't have flexibility anymore. Flexibility is gone, which is kind of funny that they still call it universal life, which they originally marketed as the fact that what you could do is have all kinds of flexibility. And you no longer have flexibility because it's used to be called secondary guaranteed universal life. You're going to see why secondary. And then they got better at marketing, just started calling it guaranteed universal life. Here's why. You put in the premium every single year, and the cash value begins to grow much like you might see it in a regular contract. But they actually plan on that cash value plateauing and running out. But what they say is as long as that premium is paid every single year for the life of the contract until the insured dies, then you will always, always, always get that death benefit.
So it's term insurance for the term of the rest of your life, whatever that term might be.
More specifically, they usually only go to 121. So they don't give us the opportunity to actually endow. They just say, think of it like term insurance to age 121. Okay. So what can go wrong, Cory? So they're giving us these guarantees. That's great. What does that mean in terms of our behavior?
So it's why it's called a secondary guarantee, because it's not primary ironclad built into the policy. There's some options for moving that. So unlike all the other policies, there is a real downside to taking money out from the moment that you start taking it out, because that erases the guarantee. So they say it changes the equation, they have to think about more things, and they say, no, we can't guarantee that anymore. So take $1 out.
Guarantee gone.
Guarantee gone. Skip a premium, try to take that flexibility, guarantee gone. Pay too much or too early, guarantee gone.
We actually had a colleague of ours that had a client on a worldwide cruise, and they were leaving early before their premium be due. So they wrote a very hefty check to pay their annual premium 3 months early. The insurance company credited that to the prior year. They have the full right to do so, and then counted the next year as not having been paid, guarantee blown.
Guarantee blown. Yep. If you change your premium mode, I think.
Yeah. If
that's
you change
a crazy
it from
one.
Annual, and then because of cash flow reasons, you need to go monthly. Well, then your guarantee could be blown. Here's the real issue. If you have one of these contracts, it's super important. We're going to talk about how to double check all of this for yourself. Here's the big problem. You need to make sure that you request an in-force illustration. If you have any type of universal life insurance, request an in-force illustration. Okay. Here's what an in-force illustration is going to do. It is going to give you a projection from this point moving forward. It's a homework that all of our clients get on their existing life insurance policies. If they're whole life or universal life, anything with a cash component, we get an in-force illustration because it's what's required to make good assessments. So let's start with if it's a guaranteed universal life. Now we're going to start at the end and go backward here.
Right.
If it's guaranteed universal life, you're looking for, are the guarantees still there? Or is there a point at which the cash is gone and so is the death benefit? If that happens, you could have done something in the past that blew your guarantee. Most of the times, these are life payment contracts. There are some that are around still that were one-time premium payments. Somebody wrote a very, very large check, one-time premium payment. Maybe they paid $300,000 and they have guaranteed forever on their life $1.5 million of coverage, or on a couple. That's also referred to as second to die life insurance. Not the conversation for today, but because second to die life insurance can exist in any of these other modes that we've just talked about. That guaranteed universal life contract, you need to stay on top of to make sure that you know what could happen with bad behavior, which is just normal behavior. Everybody's changed bank accounts or moved and not gotten a notice for some bill and paid it a little bit behind. The problem is there may be a grace period on the policy that's different than the grace period on the rider, that secondary guarantee rider. So that might have a 30-day grace period where the entire contract has a 60-day grace period, and all you're going to get is a very quiet notice in the mail that you blew the guarantee. Many people watching this may have already blown their guarantees, gotten that notice, but like we do with many insurance company notices, just went in the garbage. So that's why you got to check it, in-force illustration. When you're requesting an in-force illustration on a GUL, UL, whole life, highly recommend you call the home offices for these companies. If you request it from the home office, it tends to go faster. It's usually the person that's actually running the illustration. And sometimes they'll want to push you back to the advisor. We're not trying to have you feel like your advisor is threatened at all or whoever sold you the policy. Rather, you're just trying to learn about it yourself. If you're not worried about triggering your advisor, because anytime somebody asks for one of those, every advisor is like lit up to think they're getting rid of the policy. So they could be agitated. Just relax them, let them know you're just doing some homework. You watch this video, you can send them this video and they could watch it too. So that in-force illustration. Next is in-force illustration on the equity indexed policies. Very simple. You could request an equity indexed one at 4% and 6% average rate of return, because they're going to show it linear. They don't have a really good way to do it's called Monte Carlo or stochastic modeling on those contracts that would show the ups and downs. But if you do a really conservative estimate and then a little bit higher estimate, you're probably going to be okay. And given this was recorded in 2017, I'm going to skip all the way back to our current assumptions UL, meaning you do not have an underlying investment account. It's just the company promising you something as a rate of return each year, and it changes a little bit every year because they declare it. Just let them, in this low interest rate environment, continue to project it at current interest rates.
And that's the important piece is you can't just ask for an illustration. You have to specify their assumptions, because the assumptions they put in may not be what you're actually looking for to test the policy.
That's right. Yeah. What we're doing is tolerance testing. We want to find where the edges are. Last but not least, variable universal life. I would have you request one at 5% overall rate of return and 8% gross before fees on the contract. Okay. The fees of the underlying funds, because you can specify gross or net on those. And what's going to do, once again, is just give you the ability to make an assessment. And then you can call back. If it looks like the policy dies in 10 years, you could call back and say, hey, if this is going to last my lifetime, how much money do I need to put in every year to fund it well enough that it actually sticks around my entire life? Okay. Because that's what we're looking to do. We're not looking to have you get rid of any policies. Rather, just make sure every single one's working for you, because here's the real problem. If we get to that end state, like we looked at on these other contracts, where the policy goes down in value and then craters out, when you get that notice, it is usually a high enough premium that everybody just wholesale cancels it, which works really well for the insurance company that has all those term costs from the contract this entire time and now is off the hook in terms of death benefit. Releases reserves for them, gives them all kinds of flexibility. The problem is that may not have worked well for you. And had you taken action years before, you might have only had to change your premium a little bit to have it work out. Or maybe you did need to get a different kind of policy. And if you did get a different policy, you're going to be much better off at a younger age, better health, getting that policy. Because you know what? As much as I would like to think so, none of us get healthier with age.
We tend not to.
Yep.
Can I give a philosophical sum up of these? I don't want people to think that we're calling universal life poison.
No, in fact, we've used guaranteed universal life for some of our clients in their particular situation because it's what really worked for them in their financial affairs. It worked for them because they needed to secure a large death benefit for, say, an estate planning need or a business need that was permanent, that did not require any other type of insurance than guaranteed universal life. We have used it. We've used universal life properly funded on clients that didn't qualify for other types of insurance.
Right.
So thank you for bringing that out. Yeah, we don't want to, it's not bashing. It's just like, but we need to know where all the moving parts are.
When I started my career at a large financial institution, I got to do customer service calls for policies that had been sold in the 80s. And these people were now in their 70s having to put more and more money in each year with no guarantee that the policy actually stays in place beyond that. Right. So they're throwing money. It's kind of like getting behind with the table in Vegas and like throwing more and more to try to get back up. So it's not that they're bad. They can be useful if funded appropriately. The only problem is a lot of times they're marketed in a way as underfunded, and there's all kinds of possibilities that look amazing. And when it comes down to it, there's so many things that can change. The mechanics of it in reality are it's like they probably could behave pretty okay.
Yes.
Not amazing.
If it's
bad.
properly funded.
Yeah.
And keep in mind, when we've talked before about this current, the way everything is moving around us in the financial marketplace or in our personal lives, like the river we're all floating in, the current, the conversation everybody's in, they love being able to market things to us that have this very positive possible outcome. And
highlight the heck out of it.
And they highlight the heck out of it. And it's not that they're bad people. It's not, but it is that we need to pause long enough to make an assessment of what is the likely outcome of this. What is the likely outcome of this policy? What's the likely outcome of any investment strategy? Any place we allocate dollars, we need to make sure that we understand the likely outcomes and be able to test against them. And we hope this video will give you a chance to kind of look through some of those numbers. And if any of you get one of those and you want us to go through it live on a YouTube video, we will bring you in either in studio or we'll bring you in remotely and we'll review it with you, with everybody. Of course, with names redacted, we can put you like the old 60 Minutes with backlit and a modulated voice. Yeah, I think that'd be good. So know that if you want that reviewed, we wouldn't charge you anything for it. It'd be great for our audience to be able to see that. And then if you're looking at, well, I've kind of made a bunch of these decisions on my own, I really need some bigger help, then reach out to us about getting together. You can email us at info@sfgwa.com. Here's what we can commit to. We're only going to educate you in our philosophy conversation. That's all our advisors or myself are allowed to do. And the only thing you're allowed to do in that meeting is ask to go through our assessment where we look at what you're currently doing with a relatively short kind of assessment questionnaire, about 4 pages long. You fill out what you fill out on there, and we have a conversation about whether or not we'd be a fit. And then we charge a fee for that entire design process so that you have the choice as to whether or not you want to build it and have any incentives for us or our team to do the asset management, insurances, et cetera. That's in your court. You can have us build it after we design it like an architect that also has a general contractor, or you can go build it somewhere else or build it yourself. So we're so glad you could be with us. Here's what we're going to go to next. We are digging into how to even go about buying it or deciding how much to own of life insurance and entering into that initial conversation.